Hey, good morning, everyone. Marty Mazzora here. It's Wednesday, the 3rd of May, 2023, with your midweek stock market snapshot. It's about 15 minutes before the open. I'm going to fly through, a number of screens. We'll look at the S&P. We'll look at the NASDAQ 100 ETF. We will look at the VIX on a couple different screens. We'll touch on Apple, who reports earnings tomorrow. We'll touch on Microsoft post-earnings. Then we're going to talk about the Fed and the challenge they face presently and going forward. So we'll look at some jobs data and we'll look at some inflation data. In front of you is the S&P 500 daily, one-year daily chart, just the price chart to start with. And recall, folks, that we were favoring this bearish rising wedge over a bullish flagging pattern here, and the flag pattern has pretty much failed, and the breakout below the falling wedge was to be expected, but we came off of that. Microsoft and Meta earnings essentially saved it right here, these two massive bars. And you see Friday we closed above this resistance, and then a big down candle yesterday, closing below the 20-day moving average, which, as we pointed out, is not a good thing, particularly if we lose that in bigger fashion. We tend to see some pretty good drops if we do that and we lose that with some momentum. Still well above the 50-day moving average. I showed you over the weekend some of our breadth data where I showed that only about half of the members actually share that distinction above the 50-day moving average, and that is trending in the wrong direction. And so from a breadth standpoint, the market is not looking good. Looking at the momentum, very much still bearish. So even if we pop above here on a favorable Fed announcement today, and on earnings from Apple that come in better than expected, and maybe they, as they tend to do, announce an increase in their share buyback, we've got quite a run to go yet before we repair this technical damage down here. We still have very definite, long-lasting bearish divergences, close enough to overbought to be concerned amid other technical indicators that look somewhat bearish. But I will say this for certain: any technical pattern is no match whatsoever for a Fed announcement that would take it in the other direction. So here we have the way we look at technicals, pretty bearish pattern, but the Fed could surprise positively, and it's all about their commentary after they raise interest rates 25 basis points this morning. So on the 60-minute chart, so this is 60-minute candles over a 60-day period, we have just a very similar look on the short-term chart. You have a higher high there on the index, very definite bearish divergences, strong sell signal right here on the MACD, although of course as the markets come back it's tried to repair that, coming off of overbought levels, but not nearly as overbought as we were up here on this lower low. So this just kind of smacks of dying momentum. And then as you can see here, going into today's session, that is a bear flag. And if that plays out, which would play out with a hawkish Fed statement today, then you'd have to take this flagpole and attach it here. And that would take you to pretty close to 4,000 on the S&P, right near the top of that gap. I think we will very likely fill that gap and find resistance along the way down here. So 4,000 would be a tough nut to crack. Ultimately, we think it does if our recession call is right. And then we finally get to work on that bear market low, which we think if it happens, if recession happens, we still think it's a 2023 affair. QQQ, which is the ETF that tracks the NASDAQ 100 index. I've told you that I think this is about as bearish as it gets. The rising wedge pattern with your bearish divergences, that would have been your sell signal right in here, but it just seems very stubborn. Broke down below this resistance in this little trading range right here, this consolidation range, broke above it. As we sit here today, has failed it, but it still is sitting with support at the 20-day moving average. So the VIX, when I talked to you on the video, well, time before last, the VIX was spiking up here, and I told you that we could get Microsoft could give us something special, and the market could react, and the VIX, which tracks implied volatility on S&P 500 options, could roll over. I said I didn't think it was going to happen, and I was dead wrong on that one. And here we are sitting, with the same kind of look that we were looking at last week on the midweek update. And then here, again, the purpose of this was to show you along this bear market that when we pierced 20, that we were also losing the bear market trend line. And then here we rose above it, broke out above it, successful test, very bullish, by the way. And here's the market just, it seems like wanting to roll over. A big spike in the VIX this week would really do a number, if you will. Or it would coincide with something probably pretty big to the downside. So how does the VIX look from a pure technical perspective, looking at the way we would look at any asset class? And right now, the way it looks is that we have a lower low in price, but we have our momentum indicators diverging, and we actually have a buy signal on the moving average convergence divergence. And here's the RSI coming off of pretty low levels. So again, this right here is pretty bullish for the VIX. So this says odds favor a pop higher, which would be a spike lower in stocks. So again, Apple reports on Thursday, the biggest market cap anywhere, and really bearish look here, folks. Can't sugarcoat it. We've got a rising wedge, and we've got bearish divergences, a poor announcement tomorrow from Apple, and a break below the rising wedge, and something noticeable to the downside. We think Apple's uniquely poised for that to happen, but I said the same thing about Microsoft the other day. Remember, we were looking at this rising wedge, right? This bearish divergence, this sell signal, this overbought level and bearish divergence, and we broke out. Everything was playing out right here on this day before earnings were announced, lost this trend line. Clearly, the market was anticipating ugly results from Microsoft, and we didn't get that. Obviously, we got really good results, and we bounced right back in and above that uptrend line. However, we're still very much in a rising wedge pattern. We are back on a buy signal here, but this divergence has to get burned through. We're getting closer, but we're also getting right back up to overbought territory on Microsoft. Remember, a technical pattern, any technical pattern, certainly a short-term one, is no match for the Fed or for an earnings surprise on said company. And then some data to think about as we think about the Fed. We got the job openings and labor turnover data came out yesterday, and you can see job openings continue to drop. Now we're below 10 million. That's what the Fed wants to see. And the quits rate is dropping as well, and that just suggests poor sentiment. So this is still a pretty elevated quits rate, the rate at which people are quitting their jobs. And typically a quits rate is consistent with a good economy. People don't quit unless they're very optimistic about their prospects going forward. So that's beginning to drop. People are valuing their jobs more, right, which is consistent with a weaker economy. Still very, very, very high in terms of job openings. So still have quite a ways to go, but that's the trajectory, right? That's moving in the right direction. So you've got that going for the Fed. What you kind of have working against them is inflation, right? This is the latest from the ISM manufacturing survey, which I featured in yesterday's morning's written note. This is the prices paid component of the index actually going up. That's not what they're looking for. They're wanting to keep inflation contained. And here's a look at their preferred metric. The blue line is core personal consumptions expenditures, the deflator. So this is the inflation rate. So as you can see, of late, it's just kind of stubbornly hanging in there. Yes, it began to roll over. That's good news, certainly for what the Fed is trying to accomplish. But remember, folks, this is where they promised to get us, right, which is 2%. This is where we still are. And, one could argue, from a technical perspective, that's not It's kind of a scary bullish pattern right there, but we do expect, again, recession. Therefore, we do expect inflation to come down notably. So right now, they've got quite the conundrum, because on one end, we have these real financial stability issues, and that's part of their mandate. Yesterday, regional banks just got toasted. First Republic Bank just got gobbled up by JP Morgan, which, by the way, wasn't supposed to happen post-2008. Not supposed to allow too big to fail banks to get that much bigger. But folks, as we've learned the last few years, the rules do not matter when policymakers get scared and panicky. So the Fed are more than a little bit culpable with the environment that we find ourselves in. They've been suppressing interest rates and supporting markets, and for as long as most people can remember. And we finally now have inflation. We were forecasting structurally higher inflation before we could spell coronavirus, but of course coronavirus exacerbated everything, and here we have some real inflation, and we have banks sitting on a volcano of long-dated, low-interest rate debt, and hence you have a massive problem coming into a situation where, speaking of the regional banks, a phenomenal amount of, for example, commercial real estate lending exposure in an environment where like $1.5 trillion of that debt comes due over the next couple of years, as I understand it, in a much higher interest rate regime. So how do we get that regime down when we still have stubbornly high inflation? How do we attack financial instability and rescue the world when that's going to be viewed as bullish? It's going to push markets to the moon, and it's going to keep people out spending a lot of money, and it's going to keep this inflation stubbornly high. This is about as tough a position as any Fed, I think, has found itself in. And lots of debate as to what they'll do. The policymakers, the politicians are begging them to pause. Our economic base case says that they should be, or probably will be soon, because I think we'll be in recession. But if they pause here and they avert recession, well, then they're going to be completely failing on their inflation mandate. So this is a tough, tough environment for the Fed. The last thing in the world they ever wanted to see was stubbornly high inflation and a weakening economic backdrop, financial stability issues, and so on. So wouldn't want to be them. Tough to feel sorry for them given their lack of willingness to let markets work these past many years. But it's like the last couple of quotes on the written blog, essentially suggesting that the more you step in and try to circumvent natural forces, the more natural forces are ultimately going to punish your attempts to avert them before it's all said and done. That's kind of how it works. Certainly how it works in nature with forest fires and so on. And it's how it probably works in the economy. I think history has suggested that. So basically, we need to remain on our toes. We need to continue to hedge. And I think we can be very optimistic about the prospects and the opportunities in the next bull market. We still don't think we're there yet. Having said all that, this could be a replay of last week. A friendly Fed, you get good earnings from Apple tomorrow and maybe a tame jobs report on Friday. And we're off to the moon once again amid probably a still precarious looking technical setup and certainly a very precarious looking fundamental setup. This morning, ADP, the private payrolls number, came out way above expectations. So that would be, positive for the economy, positive for inflation in terms of higher inflation. But the ADP number and the BLS number often do not jibe with one another. And it's Friday's number, the BLS number, that everybody cares about. I'll leave it there, folks. Be back soon. Thank you, as always, for watching and listening. Have a great day. Bye-bye.